this lesson, we'll discuss the theory of efficient markets and behavioral finance. In the previous discussions, the purpose of holding the firm's capital investment decision constant is to separate that decision from the financing decision. Strictly speaking, this assumes that investment and financing decisions are independent. In many circumstances, there is a reasonable assumption. The firm is generally free to change its capital structure by repurchasing one security and issuing another. In that case, there is no need to associate a particular investment project with a particular source of cash. The firm can think first about which projects to accept and second about which should be financed. Sometimes decisions about capital structure depend on project choice or vice versa, and in those cases the investment and financing decisions have to be considered jointly. We start the lesson by contrasting investment and financing decisions. The objective in each case is the same, to maximize net present value or NPV. However, it may be harder to find positive NPV financing opportunities. The reason it is difficult to add value by clever financing decisions is that capital markets are usually efficient. By this we mean that fierce competition between investors eliminates profit opportunities and causes debt and equity issues to be fairly priced. If you think that sounds like a sweeping statement, you are right. That is why we have devoted this lesson to explaining and evaluating the efficient market hypothesis. You need to understand that efficient market hypothesis not because it is universally true, but because it leads you to ask the right questions. This is so because financing decisions seem overwhelmingly complex. Therefore, we start our discussion with this conceptual point. We define efficient market hypothesis in more detail. The hypothesis comes in different strengths depending on the information available to investors. Then we review the evidence for and against efficient markets. The evidence for is considerable, but over the years a number of puzzling anomalies have accumulated. Advocates for rational and efficient markets also have a hard time explaining bubbles. Every decade seems to find its own bubble. The 1980s real estate and stock market bubble in Japan, the 1990s technology stock bubble, and the recent real estate bubble that triggered the subprime crisis. Part of the blame for bubbles goes to incentive and agency problems that can plague even the most rational people, particularly when they are investing other people's money. But bubbles may also reflect patterns of irrational behavior that have been well documented by behavioral psychologists. We describe the main features of behavioral finance and the challenges that it poses to efficient market hypothesis. NPV computation for financing decisions. We discuss the computation of NPV of a liability. Although it is helpful to separate investment and financing decisions, there are basic similarities in the criteria for making them. The decisions to purchase a machine tool and to sell a bond each involve valuation of a risky asset. The fact that one asset is real and the other is financial doesn't matter. In both cases, we end up computing net present values. The phrase net present value of borrowing may seem odd to us. Consider the following example. As part of its policy of encouraging small businesses, the government offers to lend your firm $100,000 for 10 years at 3%. This means that the firm is liable for interest payments of $3,000 in each of the years from 1 to 10, and that it is also responsible for repaying the principal of $100,000 in the final year. Should you accept this offer? We can compute the NPV of the loan agreement in the usual way. The one difference that is the first cash flow is positive and subsequent cash flows are negative. For example, here NPV equal to amount borrowed minus present value of interest payments minus present value of loan repayment. That is equal to $100,000 minus 3,000 upon 1 plus r raised to the power t summation t equal to 1 to 10 minus $100,000 upon 1 plus r raised to the power 10. The only missing variable is r, the opportunity cost of capital. You need that to value the liability created by the loan. We reason this way. The government's loan to you is a financial asset, a piece of paper representing your promise to pay $3,000 per year plus the final repayment of $100,000. How much would that paper sell if freely traded in the capital markets? It would sell for the present value of those cash flows discounted at r, the rate of return offered by other securities issued by your firm. All you have to do to determine r is to answer the following question. What interest rate would my firm need to pay to borrow money directly from the capital markets rather than from the government. Suppose this interest rate is 10%, then $100,000 minus 3,000 upon 1 plus 10 raised to the power t summation t equal to 1 to 10 minus 100,000 divided by 1.1 raised to the power 10 equal to $100,000 minus 56,988, which is equal to 43,012. Of course, you don't need any arithmetic to tell you that borrowing at 3% is a good deal when the fair rate is 10%. But the NPV calculations tell you just how much that opportunity is worth, that is 43,012. It also brings out the essential similarity between the investment and financing decisions. To summarize, in this video, we found that the NPV computation of liability, that is financing, is same as that of an asset. The computation offers an important quantitative estimate of the worth of the financing opportunity. Differences between investment and financing decisions. We compare and contrast the investment and financing decisions. In some ways, investment decisions are simpler than financing decisions. The number of different securities and financing strategies is well into the hundreds. There are also ways in which financing decisions are much easier than investment decisions. First, financing decisions do not have the same degree of finality as investment decisions. They are easier to reverse. Second, it's harder to make money by smart financing strategies. The reason is that financial markets are more competitive than product markets. This means it is more difficult to find positive NPV financing strategies than positive NPV investment strategies. When the firm looks at capital investment decisions, it does not assume that it is facing perfect capital markets. It may have only a few competitors that specialize in the same line of business in the same geographical area, and it may own some unique assets that give it an edge over its competitors. Often, these assets are intangible, such as patents, expertise, or reputation. All this opens up the opportunity to make superior profits and find projects with positive NPVs. In financial markets, your competition is all other corporations seeking funds, to say nothing of the state, local, or federal governments that go to New York, London, and other financial centers to raise money. The investors who supply financing are comparably numerous, and they are smarts. Money attracts brains. The financial amateur often views capital markets as segmented, that is, broken down into distinct sectors. But money moves between those sectors, and it is usually moves fast. In general, as we shall see, firms should assume that the securities they issue are fairly priced. That takes us into the main topic of this chapter, that is efficient capital markets. To summarize, in this video, we compared the investment and financing decisions. While the NPV computation of investment and financing decisions are similar, there are important differences. For example, unlike the market for investment, market for financing is extremely competitive. Hence, it is extremely difficult to generate positive NPV financing. What is an efficient market? We'll discuss the properties of an efficient market. Security prices seem to follow random walk. What is a random walk process? A process is a random walk process if the successive changes are independent. That is, the chance of getting an outcome is independent of its historical values. Consider a simple example of a coin tossing game. At the end of each week, a coin is tossed. If it comes up heads, you win 3% of your investment. If it is tail, you lose 2.5%. This is a sort of random walk process, though not strictly in the sense that is the odds each week are the same regardless of the value at the start of the week or of the patterns of heads and tails in the previous weeks. Similarly, as per random walk model, the price changes are independent of one another, just as the gains and losses in our coin tossing game. They were independent. One can easily set up tests to examine the patterns in these price movements. For example, one can compute correlation coefficients between price changes at each of the successive days. If prices persist, then one can expect to find some correlation across price changes and no correlation if there is purely a random walk in price changes. Consider the following 4 examples of correlations as shown in the figure here. Each dot shows a pair of returns for a stock on 2 consecutive days. The circle dot of Microsoft records a daily return of 3% positive and then minus 3% on the next day. The scatter diagram shows no significant relationship between returns on successive days. If price movements persisted, the correlation would be positive. If there were no relationship, it would be zero. For example, the correlation between successive price changes in Microsoft was minus 0.019. This indicated that there was very small tendency for price rises to be followed by price falls. For Philips, this correlation was also negative at minus 0.30. However, for BP and Sony, the correlations were positive as plus 0.004 and plus 0.026 respectively. In these cases, there was a negligible tendency for prices to rise and to be followed by further price rises. These figures suggest that successive price changes for all four stocks were effectively uncorrelated. Today's price change gave investors almost no clue as to the likely change tomorrow. Imagine if this was not the case and that the changes in Microsoft's stock price were expected to persist for several months. Now, consider the figure shown here that provides an example of such a predictable cycle. You can see that an upswing in Microsoft stock price started last month when the price was $20. And it is expected to carry the price to $40 next month. As soon as the investors perceive this opportunity, they will act on it, and it will evaporate immediately. Since Microsoft stock is a bargain at $30, investors will rush to buy. They'll stop buying only when the stock offers a normal rate of return. Therefore, as soon as the cycle becomes apparent to investors, they immediately eliminate it by trading activity. Such kind of cycles self-destruct as soon as they are recognized by investors. The stock prices instantaneously jump to the present value of the expected future price. To summarize, in this video, we discussed that efficient markets are those where prices follow random walk. That is, future price changes have no correlation with historical price changes. For every period, these changes are independent. Moreover, in these markets, any information related to price expectations is swiftly incorporated in prices as investors exploit the new information speedily. Theory of market efficiency. We'll discuss the theory of market efficiency and also contrast the theory with the evidence available from real financial markets. As we have discussed that prices in competitive markets must follow a random walk. If past price changes could be used to predict future price changes, investors could make easy profits. But in competitive markets, easy profits don't last. As investors try to take advantage of the information in past prices, prices adjust immediately until the superior profits from studying past price movements disappear. As a result, all the information in past prices will be reflected in today's stock price, not tomorrow's. Patterns in prices will no longer exist and price changes in one period will be independent of changes in the next. In other words, the share price will follow a random walk. In competitive markets, today's stock price must be already reflecting the information in historical prices. But why stop there? If markets are competitive, shouldn't today's stock price reflect all the information that is available to investors? If so, securities will be fairly priced and security returns will be unpredictable. No one earns consistently superior returns in such a market. Collecting more information won't help because all available information is already impounded in today's stock prices. Economists define three levels of market efficiency that are distinguished by the degree of information reflected in security prices. In the first level, prices reflect information contained in the record of past prices. This is called weak form of market efficiency. If markets are efficient in the weak form sense, then it is possible to make consistently superior profits by studying historical returns. Prices will follow a random walk. The second level of efficiency requires that prices reflect not just the past prices but all other public information. For example, information from the internet or financial press. This is known as semi-strong form of market efficiency. If markets are semi-strong form efficient, then prices will adjust immediately to public information such as the announcement of the last quarter's earning, a new issue of stock, or a proposal to merge two companies. With strong form market efficiency, prices reflect all the information that can be acquired by painstaking analysis of the company and economy. In such a market, we would observe lucky and unlucky investors, but we wouldn't find any superior investment managers who can consistently beat the market. In order to test the weak form of a hypothesis, researchers measure the profitability of some of the trading rules used by those investors who claim to find pattern in security prices. These are statistical tests to examine the predictability of future prices using current prices. These are mostly time series tests related to forecasting. To analyze the semi-strong form of market hypothesis, researchers measure how rapidly security prices respond to different items of news such as earnings or dividend announcements, news of a takeover, or macroeconomic information. Consider an example of a news that a company is being target of acquisition coming into public. It is of great interest to examine how security prices would respond to this news. Consider the figure shown here. The performance of the stocks of target companies compared with that of the market. The prices of the target stocks jump on the announcement day, but from then on, there are no unusual price movements. The announcement of the takeover attempt seems to be fully reflected in the stock price on the announcement day. The graph here shows the abnormal returns on the firms that are target takeovers. Since the acquiring firm usually have to pay a substantial takeover premium to get the deal done, the target stock price increases as soon as the takeover bid is announced. The figure here shows the average pattern of the stock's target returns before and after the announcement of a takeover, that is day 0 in the figure. Stock prices drift up before date 0 as investors gradually realize that a takeover may be coming. On the announcement day, prices jump up dramatically. The stock price adjustment is immediate and complete. After the big price move on the public announcement day, the run-up is over, and there is no significant further drift in the stock price, either upward or downward. Thus, within the day, the stock prices reflect, at least on average, the magnitude of the takeover premium. Tests of strong form of hypothesis have examined the recommendation of professional security analysts and have looked for mutual fund or pension funds that could predictably outperform the market. Some researchers have found a slight persistent outperformance, but just as many have concluded that professionally managed funds fail to recoup the cost of management. It has been observed that some years these funds and portfolio managers do better than market, but in many more years they do worse as well. To control for fund specific differences, low beta and large firm stocks, each fund needs to be compared with a benchmark portfolio of similar securities. Many studies have done this with the following conclusion. The funds earned a lower return than the benchmark portfolios after expenses and roughly match the portfolios before expenses. It would be surprising if some managers were not smarter than others and could earn superior returns. But it seems difficult to spot the smart ones, and the evidence from literature suggests that the top performing managers on a given year have about an average chance of failing on their faces the next year as well. The evidence on efficient markets has convinced many professionals and individual investors to give up the pursuit of superior performance. They simply buy the index which maximizes the diversification and cuts the cost to the bone. Individual investors can buy index funds, which are mutual funds that track stock market indices. There is no active management, and therefore so costs have become very low. But how far can indexing go? Not to 100%. If all investors hold index funds, then nobody will be collecting information and prices will not respond to new information when it arrives. An efficient market needs some smart investors who gather information and attempt to profit from it. To provide incentives to gather costly information, prices cannot reflect all the information. there must be some profits available to allow the cost of information to be recouped. But if the costs are small relative to the total market value of traded securities, then the financial market can still be close to perfect efficient. To summarize, in this video we discussed that it is extremely difficult to predict prices in financial markets. That is, they follow random walk model of price changes. The theory of market efficiency suggests three forms of market efficiency, that is weak form, semi-strong form and strong form of efficiency. Weak form efficiency suggests that one cannot predict prices using historical information. Semi-strong form efficiency suggests that one cannot predict prices using publicly available information. Semi-strong form efficiency is the highest form of efficiency, that one cannot predict prices using any information, including private information. Semi-strong form of efficiency suggests that one cannot predict prices using publicly available information. A strong form efficiency is the highest form of efficiency, suggesting that one cannot predict prices using any information, including private information. The evidence against market efficiency. We'll discuss the evidence against market efficiency. We'll also discuss some of the plausible explanations to these violations of market efficiency. Research has concluded that efficient market hypothesis is a remarkably good description of reality. However, a number of research articles in literature suggest that there are indeed anomalies that can be exploited and contradict the notion of market efficiency. What exactly is this anomaly? So far, we have connected market efficiency to the absence of opportunities to make money. More precisely, in an efficient market, it is not possible to find expected returns greater or less than the risk-adjusted opportunity cost of capital. This implies that every security trades at its fundamental value based on future cash flows, that is CT, and the opportunity cost of capital R. So the discounted price formula is P equal to summation CT upon 1 plus R raised to the power T equal to 1 to infinite. If price equals fundamental value, then the expected return is the opportunity cost of capital, no more and no less. If price differs from fundamental value, then investors can earn more than the cost of capital by selling if the price is too high and buying when it is too low. This comes from the principle of common stock valuation. However, the principle tells us that you can't identify superior returns unless you know what the normal expected return is. Therefore, if you try to determine whether a market is efficient, you usually have to adopt an asset pricing model that specifies the relationship between risk and expected return. Any test of market efficiency is then essentially a combined test of efficiency and the asset pricing model. Any test of an asset pricing model is also a combined test of the model and market efficiency. The most commonly used asset pricing model is KAPM. A number of KAPM violations have been found in the literature. This includes the abnormally high returns on the stocks of small firms vis-a-vis large firms. Now, this may mean one or many of the several things. First, it could be that investors have demanded a higher expected return from small firms to compensate for some risk factor that is not captured in the simple capital asset pricing model. Those who believe that the small firm effect is a pervasive phenomena can point to the fact that small firm stocks have provided a higher return in many other countries. However, it is also observed that the small firm effect seems to have disappeared as it is documented. Third, the small firm effect would be important exception to the efficient market theory, an exception that gave investors the opportunity for consistently superior returns over a period of several decades. If these anomalies offer easy pickings, you would expect to find a number of investors eager to take advantage of them. It turns out that while many investors do try to exploit such anomalies, it is surprisingly difficult to get rich by doing so. We have dwelt on the small firm effect, but there is no shortage of other puzzles and anomalies. Some of them relate to the short-term behavior of stock prices. For example, returns appear to be higher in January than in other months. They seem to be lower on Monday than on other days of the week. and most of the daily returns come at the beginning and end of the day. Long-term investors are usually less concerned with these short-term mispricings. They are more interested in the long-lasting inefficiencies such as the earnings announcement puzzle. It seems that investors underreact to the earnings announcement and become aware of the full significance only as the further information arrives. The new shoe puzzle: when firms issue stock to the public, investors typically rush to buy. On average, those lucky enough to receive the stock receive an immediate gain. However, researchers have found that these early gains often turn into losses. Another interesting phenomenon is bubbles and market efficiency. There are cases where prices can no longer be justified with fundamentals. Valuation of stocks from scratch through methods such as dividend growth model is extremely difficult, as the assumptions related to growth and opportunity cost are very difficult to make. It is often easier for investors to price a common stock related to yesterday's price or related to today's price of comparable securities. In other words, they generally take yesterday's price as correct, adjusting upward or downward on the basis of today's information. If information arrives smoothly, then as time passes, investors become increasingly confident that today's price level is correct. But when investors lose confidence in the benchmark of yesterday's price, there may be a period of confused trading and volatile prices before a new benchmark is established. Second, most of the tests of market efficiency are concerned with relative prices and focus on whether there are easy profits to be made. It is almost impossible to test whether stocks are correctly valued because no one can measure true value with any precision with methods such as dividend growth model and stay confident about it. It may be possible to prove that market levels are or are not consistent with fundamentals. However, every now and again, investors seem to be caught up in a speculative frenzy and asset prices then reach levels that, at least with hindsight, cannot be easily justified by the outlook for profits and dividends. Investors refer to such occasions as bubbles. Bubbles can result when prices rise rapidly and more investors join the game on the assumption that prices will continue to rise. These bubbles can be self-sustaining for a while. It can be rational to jump on the bandwagon as long as you are sure that there will be greater fools that you can sell out to. But remember that lots of money will be lost, perhaps by you, when the bubbles burst. For example, dot-com bubble of 2000 and Japanese stock market bubble from 1990s. To summarize, in this video we discussed that efficient market theory is a reasonably good description of market reality. To summarize, in this video we discussed that efficient market theory is a reasonably good description of market reality. However, over the years, a number of anomalies have been observed, such as day of the week effect, month of the year effect, small firm effect, etc. Many of these anomalies have disappeared once identified by the investors. Various plausible explanations have been offered to explain these anomalies. First, it is extremely difficult to ascertain the fundamental price and therefore difficult to maintain with a price that is different from the fundamental prices. Often, the examination of market efficiency is also a test of asset pricing model. That is how accurately that asset pricing model is held. Next, many times anomaly may not indeed be an anomaly, but additional returns may be the compensation for some unidentified risk factor. For example, small firm effect is considered as a premium desired by the investors to hold small stocks as they may be considered risky. Many times markets are not consistent with the fundamentals, and in such scenarios the bubbles burst, leading to huge losses. Investor psychology and behavioral finance. We discussed the behavioral aspects that drive prices away from their fundamental and efficient values. Often, prices depart from fundamental values. One of the interesting explanations provided by behavioral psychology is that people are not 100% rational 100% of the times. This shows up in investors' attitudes to risk and the way they assess probabilities. We'll discuss these aspects one by one. First, attitudes towards risk. Psychologists have observed that while making risky decisions, people are particularly loath to incur losses. It seems that investors do not focus solely on the current value of their holdings, but look back at whether their investments are showing as a profit or loss. For example, if I sell my holding of IBM stock for $10,000, I may feel on the top of the world if the stock only cost me $5,000, but I'll be much less happy if it had cost $11,000. This observation is the basis for prospect theory. Prospect theory states that A. The value investors place on a particular outcome is determined by the gains or losses that they have made since the asset was acquired or the holding last reviewed. And B. Investors are particularly averse to the possibility of even a very small loss and need a high return to compensate for it. Next, we have beliefs about probabilities. Investors often make errors in assessing the probability of uncertain events. Psychologists have found that when judging possible future outcomes, investors individually tend to look back at what happened in a few similar situations. As a result, they are led to place too much weight on the small number of recent events. For example, an investor might judge that an investment manager is particularly skilled because he has beaten the market for 3 years in a row, or that 3 years of rapidly rising prices are a good indication of future profits from investing in the stock market. The investor may not stop to reflect on how little one can gain or learn about the expected returns from 3 years' experience. Also, various individuals are too conservative in their nature, that is, they are too slow to update their beliefs in the face of new evidence. People tend to update their beliefs in the correct direction, but the magnitude of the change is less than rationally or rationality would require. Another systematic bias is overconfident investors, that is, overconfidence. Most investors think they are better than average stock pickers. Two speculators who trade with each other cannot make money both at the same time, but may be prepared to continue trading because each is confident that he is better than the other. Overconfidence shows up in the certainty that people express about their judgments. They consistently overestimate the odds that the future will turn out as they say and underestimate the chances of unlikely events. These behavioral biases help in explaining anomalies such as bubbles. As prices rise, they generated increased optimism about the future and stimulated additional demand. The more that investors rack the profits, the more confident they become in their views and the more willing they are to bear the risk that next month may not be so good. Next, you have limits to arbitrage. There are plenty of hard-headed professional investors managing huge sums of money. Why don't these investors bail out of overpriced stocks and force their prices down to their fair values? One reason is that there are limits to arbitrage. That is, limits on the ability of rational investors to exploit market inefficiencies. Strictly speaking, arbitrage means an investment strategy that guarantees superior returns without any risk. In practice, arbitrage is defined more casually as a strategy that exploits market efficiency and generates superior returns, and when prices return to fundamental values. Such strategies can be very rewarding, but they are rarely risk-free. In an efficient market, if prices get out of line, then arbitrage forces them back. The arbitrager buys the underpriced securities, pushing up their prices, and sells the overpriced securities, pushing down their prices. The arbitrager earns a profit by buying low and selling high and waiting for prices to converge to fundamentals. Thus, arbitrage trading is often called convergence trading. In practice, arbitrage is harder than it looks. Trading costs can be significant and some trades are difficult to execute. For example, suppose that you identify an overpriced security that is not in your existing portfolio. Then you want to sell high, but how do you sell a stock that you do not own? It can be done, but you have to sell the stock short. To sell a stock short, you borrow shares from another investor's portfolio, sell them, and then wait hopefully that until the price falls and you can buy the stock back for less than what you sold it for. If you're wrong and the stock price increases, then sooner or later you'll be forced to repurchase the stock at a higher price and therefore at a loss to return the borrowed shares to the lender. But if you're right and the price does fall, you purchase you repurchase, pocket the difference between the sale and purchase prices, and return the borrowed shares. In addition, there are costs and fees to be paid, and in some cases, you will not be able to find the shares to borrow. To summarize, in this video, we discussed that often individuals do not behave rationally. These behavioral aspects cause or drive prices away from their efficient values. For example, people are particularly averse to losses. They often put additional weight to more recent events in the probabilities. Also, there are limits to arbitrage. These issues force prices to remain away from their fundamental values over considerably long periods of time. Key implications of market efficiency. We'll discuss the practical implications of market efficiency for real-world markets. The efficient market hypothesis emphasizes that arbitrage will rapidly eliminate any profit opportunities and drive market prices back to their fair values. Behavioral finance specialists may concede that there are no easy profits, but argue that arbitrage is costly and sometimes slow working, so that deviations from fair value may persist. Sorting out the puzzles will take time, but we suggest that financial managers should assume, at least as a starting point, that there are no free lunches to be had in financial markets. The no free lunch principle gives us the following 6 lessons of market efficiency. Lesson 1 is markets have no memory. That is the weak form of efficient market hypothesis, which states that the sequence of past price changes contain no information about future changes. Economists express the same idea more concisely when they say that the market has no memory. Sometimes financial managers seem to act as if this were not the case. For example, after an abnormal market rise, managers prefer to issue equity rather than debt. The idea is to catch the market while it is high. Similarly, they are often reluctant to issue stock after a fall in prices. The second lesson is trust market prices. In an efficient market, you can trust prices, for they impound all the available information about the value of each security. This means that in an efficient market, there is no way for most investors to achieve consistently superior returns. To do so, you do not only have to know more than anyone else, you also need to know more than everybody else. This message is important for the financial manager who is responsible for the firm's exchange rate policy or for its purchases and sales of debt. If you operate on the basis that you are smarter than others at predicting currency changes or interest rate movements, instead of using consistent rational financial policy, you will act on the whims and fancies that may prove wrong very often. Third lesson is read the entrails. If market is efficient, prices impound all the available information. Therefore, if we can only learn to read the entrails, security prices can tell us a lot about the future. The market's assessment of the company's security can also provide important information about the firm's prospect. Thus, if a company's bonds are trading at low prices, you can deduce that the firm is probably in trouble. Consider the following example. Suppose that investors are confident that interest rates are set to rise over the next year. In that case, they will prefer to wait before they make long-term loans. And any firm that wants to borrow long-term money today will have to offer the inducement of higher rates of interest. In other words, the long-term rate of interest will have to be higher than the one-year rate. Differences between these long-term interest rate and the short-term interest rate tell you something about what investors might expect to happen to short-term rates in future. Lesson 4 is that there are no financial illusions. In an efficient market, there are no financial illusions. Investors are only concerned with the firm's cash flows and the proportion of those cash flows to which they are entitled. However, there are occasions on which managers seem to assume that investors suffer from financial illusion. For example, some firms devote considerably long time ingenuity to the task of manipulating earnings reported to stockholders. This is done by creative accounting, that is, by choosing accounting methods that stabilize and increase reported earnings. Presumably, firms go to this trouble because management believes that stockholders take the figures at face value. The theory of efficient market suggests that investors cannot be fooled by such financial illusion. Lesson number 5 is do-it-yourself alternative. In an efficient market, investors will not pay others for what they can do equally well for themselves. As we shall see, many of the controversies in corporate financing center on how well individuals can replicate corporate financial decisions. For example, companies often justify mergers on the grounds that they produce a more diversified and hence more stable firm. But if investors can hold the stocks of both companies, why should they thank the companies for diversifying? It is much easier and cheaper for them to diversify than it is for the firm. The financial manager needs to ask the same question when considering whether it is better to issue debt or common stock. If the firm issues debt, it will create financial leverage. As a result, the stock will become more risky and it will offer higher expected return. But stockholders can obtain financial leverage without the firms issuing debt. They can borrow on their own accounts. The problem for financial manager is therefore to decide whether the company can issue debt more cheaply than individual shareholders. Lesson number 6, seen one stock, seen them all. Investors don't buy a stock for its unique qualities. They buy it because it offers the prospect of a fair return for its risk. This means that stocks are likely to be perfect substitutes to each other. Therefore, the demand for a company's stock should be highly elastic. If its prospective return is low relative to its risk, nobody will want to hold that stock. If the reverse is true, that is, it offers higher return relative to its risk, everybody will want to buy that stock. To summarize, in this video, we discussed the implications of efficient market hypothesis for real markets. Starting with, first, markets have no memory and future changes in prices are independent of historical changes. Second, markets are the best judge for company prospects and therefore prices reflect what to expect about the firm in future. Third, on average, one should trust markets and not on the supremacy of financial managers. Fourth, investors cannot be fooled by artificially manipulating financial statements, that is creating financial illusions. Fifth, investors do not reward financial markets for the actions that they can themselves replicate at cheap costs. And finally, six, stocks are perfect substitutes to each other. That is, if one stock offers lower expected return corresponding to its risk, then nobody will hold it. And if it offers higher risk adjusted returns, then everybody will hold it. Competition between investors will tend to produce an efficient market. In such a market, prices will rapidly impound any new information and it will be difficult to make consistently superior returns. We may indeed hope, but all we can rationally expect in an efficient market is a return just sufficient to compensate us for the time value of money and for the risk we bear. The efficient market hypothesis comes in three different flavors. The weak form of the hypothesis states that prices efficiently reflect all the information in the past series of stock prices. In this case, it is impossible to earn superior returns simply by looking for patterns in stock prices. In other words, prices change are random. The semi-strong form of the hypothesis states that prices reflect all published information. That means it is impossible to make consistently superior returns just by reading the newspaper, looking at the company's annual accounts, and so on. The strong form of the hypothesis states that stock prices effectively impound all available information. It tells us that superior information is hard to find because in pursuing it, you are in competition with thousands, perhaps millions of active, intelligent, and greedy investors. The best you can do in this case is to assume that securities are fairly priced. Limits to arbitrage can explain why assets may get out of line with fundamental values. Behavioral finance, which relies on psychological evidence to interpret investor behavior, is consistent with many of the deviations from market efficiency. Behavioral finance says that investors are averse to even small losses, especially when recent investment returns have been disappointing. Investors may rely too much on a few recent events in predicting the future. They may be overconfident in their predictions and may be sluggish in reacting to new information.